Hi everyone, a very good afternoon to all of you present here. I'm Nitisha Jain, Assistant Manager of Taxability.com, and I welcome you all in our today's session about taxation of residents and non-residents. So before starting the session, I would like to welcome you all who all have joined, and I'll try to make the session a very useful and interactive one for all of you guys. So meanwhile, during the session, if you have any doubts, you can just type in the chat box and I'll be answering all the questions at the end of the session once I'm done with the PPT part. So let's move towards our today's session, and talking about our today's agenda, we are going to discuss first of all the introduction part, and then what is the residential status, who are non-residents, then what were the special relief which were given in COVID lockdown period to NRIs, how their tax liabilities were calculated. We'll be seeing about all those things. Then how NRI can prevent DTAA, which is double taxation avoidance agreement. Then what are the documents which are required for the NRI to file their taxes, and this will be followed up by Q&A session. So coming on to our first topic about the introduction part. So the income tax department must determine the residential status of taxpayers regardless of whether they are individuals or companies. This information becomes pertinent during tax filing season. This is actually one of the main factors that determine a person's taxability. Meaning and importance of residential status taxability of an individual is dependent on his Indian residential status. What the For a particular financial year. So Indian income tax law explains what the term residential status means. Both citizenship and residential status are distinct aspects. Some people have this myth that the citizenship and whatever residential status is I'm having, both the things are same. But this is not the case. Citizenship is a different thing, and your residential status of a particular country is a different thing. A person may be Indian citizen, but it does not necessarily mean that they must be a resident in India for a specific year. So Section 6 of the Income Tax Act 1961 contains provisions that relate to the determination of the residential status of a person. Now, how we can determine the residential status? Coming on to that, talking about that particular thing. So, for the purpose of income tax in India, the income tax law classifies taxable person as a resident but not ordinarily resident, which we call as RNOR. And third category is a non-resident. The taxability differs for each of the above category of taxpayers. Before we get into the taxability, let us first understand how a taxpayer becomes a resident but not ordinarily resident, or a non-resident. So first of all, coming on to the resident part. A taxpayer would qualify as a resident in India if he satisfies one of the following two conditions. First condition is that he or she stays in India for a year is 182 days or more. Second, stays in India for immediately 4 preceding years is 365 days or more, and 60 days or more in the relevant financial year. In the event an individual who is citizen of India or a person of Indian origin leaves India for employment during a financial year, he will qualify as a resident of India only if he or she stays in India for 182 days or more. Such individuals are allowed a longer time greater than 60 days and less than 182 days in India. But one amendment came, and from the financial year 2020-21 onwards, the period is reduced to 120 days or more for such an individual whose total income other than foreign sources exceeds rupees 15 lakh. I repeat that 182 days period has been reduced to now 120 days or more only for those individuals whose total income other than foreign sources is exceeding rupees 15 lakh. In another significant amendment from financial year 2021, an individual who is a citizen of India who is not liable of tax in any other country will be deemed to be a resident in India. The condition for deemed residential status applies only if the total income other than foreign sources exceeds rupees 15 lakh and nil tax liability in other countries or territories by the reason of his domicile or residence or any other criteria of the similar nature. So there is one table over here. Here you will see that period of stay in India in current financial year. If it is 182 days or more, then that person will be considered as a resident of India. But if that person's stay is less than 182 days, then we'll have to see that is it 120 days or more but less than 182 days. In that also there will be two conditions. First one will be the Indian citizen whose income is less than 15 lakh or income other than foreign sources. Then he will be called as resident but not ordinary resident from financial year 2021 onwards. But if he is falling into any other category, then he'll be considered as non-resident. But if his or her period of stay in India was less than 120 days, then he'll be considered as non-resident of India. I mean, resident of India is different category, and but if it stay is 120 days or less, then he'll be considered as non-resident. Then coming on to in detail about resident but not ordinary resident, if an individual qualifies as resident, then the next step is to determine if he or she is a resident, resident but ordinary resident, or resident but non-ordinary resident. He will be a resident but ordinary resident if he meets both of the following two conditions. First condition is that if he has been a resident in India in at least 2 out of 10 years immediately previous years, and second condition is that he has stayed in India for at least 730 days in 7 immediately preceding financial years. Therefore, if any individual fails to satisfy even one of the above conditions, then he would be categorized as resident but not ordinary resident. But from financial year 2021, citizen of India or a person of India origin who leaves India for employment outside India during the year will be considered as resident and ordinary resident if he stays in India for an aggregate period of 182 days or more. But this condition will apply only if his total income other than foreign sources exceeds 15 lakh. Also, a citizen of India who is deemed to be resident of India with effect from financial year 2021 will be resident and ordinary resident in India. And there is one more thing to remember in this case, that if there is any income from foreign sources, it means income which accrues or arise outside India, except income which is derived from business controlled in India or any profession set up in India. Then coming on to our next topic, which is about the non-resident. So the non-resident, one second. Coming on to the non-resident topic, we all know that the taxes collected from citizens are the foundation of the Indian economy. NRI taxation under the Income Tax Act 1961 applies to those earnings income outside their home country. The income tax rules and perks allowed to them are drastically different from those which are applicable to the resident Indians. Now we'll see that what are those changes and what are all those things. Till the end of financial year 1920, that is financial year ended 31st March 2020, NRIs, which covers Indian citizens and persons of Indian origin, included those individuals who, being outside India, visited India for less than 182 days in a financial year. But the Finance Act 2020 reduced this period to 120 days in cases where the total taxable income Indian income, which means income which is accruing in India of such visiting individuals during the financial year is more than 15 lakh rupees. Accordingly, visiting NRIs whose total income, which is defined as taxable income in India, if it is up to 15 lakh during the financial year, will continue to remain NRI only if the stay period does not exceed 181 days as was the case earlier. As such, besides the monitoring the number of days present in India, the visiting NRIs are also required to keep tab of their Indian taxable income. This is because once the taxable Indian income exceeds rupees 15 lakh, then the provision related to stay exceeding 120 days will be applicable. It may be noted that dividend distributed by Indian companies are now taxable in the hands of shareholders and as such would form part of the taxable income. On the other hand, since the interest, any interest income from deposits or anything from NRE deposits are exempt, it will not form part of the taxable income. Further, an NRI whose taxable income exceeds rupees 15 lakh and stay in India for 120 days or more, then such an individual further needs to check that whether his stay in India is for 365 days or more in immediately four preceding financial years. Let us assume that a non-resident visits India in financial year 22-23 and his taxable income was in the financial year, it was 15 lakh, exceeding 15 lakh rupees. And he stays for a period of 130 days. Further, during the four preceding financial years, that was from financial year 2021, 1920, 1890, and 1718, he was in India for a total of 365 days or more. In such a case, he will be treated as a resident individual for income tax purposes. While this may ring alarm bells for many NRIs, but in relief, they will be treated as resident but not ordinary resident, RNOR. This would be a relief as their foreign income, that is the income which is accrued outside India, shall not be taxable in India. Now they have also got some special relief due to COVID lockdown period. So for financial year 1920, if any individual would have visited to India on or before 22nd March 2020, and first condition is that they were unable to leave India because of lockdown on or before 31st March 2020 period. Then the period of stay from 22nd March to 31st March will not be considered in their case. Second condition was they were quarantined due to COVID-19 on or after 1st March 2020 and departed on evacuation flight on or before 31st March 2020. Or we can say they were unable to leave India. Then the period of stay, which is starting from the quarantine period to 31st March 2020, shall not be considered. Then the third condition was that they departed on an evacuation flight on or before 31st March 2020. So the period of stay starting from 22nd March 2020 to the date of their departure will not be considered. This was the special relief which are provided to the NRIs who came to India and got stuck, or when they wanted to come through the evacuation flight. All these scenarios were there, and the government specially provided these all the kinds of relief to the NRIs individual, and their period of stay was not considered according to these conditions. Then coming on to our next topic, which is about the double taxation, DTAA. So if so what is double taxation? First of all, double taxation is a situation where an income is subject to tax twice. This can occur in one of the two ways, economical or judicial. Economical double taxation occurs if an income or a part of it is taxed twice in the same country in the hands of two individuals. Alternatively, judicial double taxation occurs if income earned outside India is taxed two times in the hands of the same individual, once abroad and once in their home country. This unique situation puts an undue burden on the taxpayers where their income is taxed twice. Then, many times, if you live abroad and have an income source in India as well, you will be taxed in both your country and the place where you reside. Thus, India has implemented the DTAA policy, which means Double Tax Avoidance Agreement policy. It is a tax treaty that India signs with another country in order to avoid the double taxation. Using this treaty, an individual can avoid being taxed twice. DTAAs can either be comprehensive agreements, which covers all the types of income, or specific agreements, which target only certain type of income. For example, there is a DTAA between India and Singapore, under which income is taxed based on the residential status of the individual. This streamlines the flow of taxation and ensures that the individual is not taxed twice for the income which is earned outside India. And currently, India has DTAAs in place with more than 80 countries. Many people believe that the DTAA will allow them to avoid paying taxes altogether, but that is not true. Since the DTAA allows for the rebate, not a total deduction, NRIs can decrease their tax implications when they earn income in India. Now, how can NRI avoid the double taxation? Uh, Avoid the double taxation, yes. NRIs can avoid the double taxation, meaning getting taxed on the same income twice in the country of residence and India by seeking relief from the double taxation avoidance agreement between the two countries. Under DTAA, there are two methods to claim tax relief. First is exemption method and second is tax credit method. By exemption method, NRIs are taxed in only one country and exempted in another. In the tax credit method, where the income is taxed in both the countries, tax relief can be claimed in the country of residence. In Budget 2021, our Finance Minister proposes a new section, Section 89A, where it notifies rules of removing the hardships for NRIs, specified persons, due to double taxations on money which is accrued in foreign retirement accounts. The provision is applicable when the income from such accounts are not taxed on accrual basis, but the notified foreign countries tax it at the same time of at the time of withdrawal or redemption of the funds from the said account. This was about the this double taxation thing. And now talking about the documents. The documents to be submitted include the passport to show the number of days which is spent outside India to qualify as an NRI. Besides this, the NRI needs to provide the statement for the demat account, for the transactions and bank account which is held in India, as well as the TDS certificate which is received from the other parties. These are all the documents which are required to have. Then if you are filing the NRI taxation, then you will also have to file the form 67 on the income tax website. Only after that, if you are having any kind of relief, then you are good to go with that. Then further thing, NRIs who are filing tax will also get an exemption up to 2.5 lakh limit. But if you say that your age is above 60 years and you are senior citizen, so will I get the exemption limit of 3 lakh or 5 lakh which is available to a resident? So in that situation, the answer is no. For a non-resident, exemption limit is fixed, which is up to 2.5 lakh rupees, whatever your age, whatever age group you are falling into. But the exemption limit will be up to 2,50,000 only if you are filing the income tax return. So this was all about the NRI taxation thing. Now, if you are having any question, then I'm happy to answer that. Are we having any question? I think there are no further questions. Okay, then we are good to wind up the session. Thank you so much all for joining the session. I hope it was useful for the people who are having the NRI income as well. And see you in the next session. Thank you so much everyone for joining. See you.